Hello, everybody. Happy New Year, and welcome to the Quadriga stable return update for the month of December. As usual, for potential clients and potential interested investors who don't know the fund strategy, I'm gonna give you a quick overview of the quick presentation of the strategy, and then we're gonna go through the December month and the end of year, and then also a quick macro update for 2022. So as our philosophy is in the long term, investment success is not just about compounding capital and beta, but also capabilities of capital preservation in the short term. So we put together risk-on strategies and risk-off strategies at the same time. And the today issue is well known. This slide is it's an old slide. It's already old, let's say 2 years old, but still the problem stays the same. We have cash and money markets, which is let's say they don't offer any positive yields. The yields are all negative, especially for a European investor who invests in Europe. Then going into more fixed income and duration, the risk reward of investing in these instruments is pretty poor, and they can be also dangerous and volatile. And we have a sense of what's going on the first week of January, where there's been a quick burst steepening of the curve in the US and Europe, and bond yields at 10 years are getting to zero, and clients who invested in minus 40 basis points 2 months ago, they're already losing 4% on their investment. And in terms of credit, high yield, the picture is kind of the same of fixed income, especially for investment grade, or since the spreads have been are still very low. The cushion of investment grade to the duration risk is pretty limited. It's negligible. So investment grade is very correlated to medium to long term government bonds, and high yield short-term duration offer very low spreads, although they can avoid the duration risk. They offer still some attractive returns, but you need to be nimble, dynamic to find those type of investments. And then, of course, equity, private and public equity, we still see some good risk reward and some potential return, especially in value and quality type of stocks, and trying to avoid the frothy, hyper-valued stocks, which already been since June last year. They lost a good amount of money. The companies like Zoom, Peloton, down 40%. Still, we see the market kind of expensive in those type of stocks. So valuation there is expensive, but when there is a risk of sentiment in market, especially for short-term periods, there is no way to hide also in good quality and value stocks. So in order to preserve capital, it's difficult to invest just in equity, although in the long term they can offer attractive real returns. So what we did essentially, we went from a classic asset allocation model to a behavior allocation model, where behavior, we mean how an asset or a strategy behaves. For a strategy, we mean a long-short strategy, a pair trade in equity, or also a long and short in bonds and credit, or relative value trades in in fixed income, or carry trades in currencies, for example. So for us, putting together two instruments, two different assets in a long, short way, combined into a strategy, and the strategy has a pattern, a behavior, which is kind of consistent what happened in the past, in stress period and in quiet periods. So we assess if a strategy is a risk-on strategy. The classical carry trade with emerging market currency, for example, is a classical risk-on strategy, which we call striker, using football, European football analogy. And a strategy is very defensive, so it's a mirror. We call it, let's say, defender. It is a risk-off strategy. And everything else, which is more idiosyncratic, which depend less on, which can also be capital preservation or lose not very amount of good, like a big amount of money during stress period, we call it pure uncorrelated or pure alpha type of strategies. So of course, it's the pure alpha is harder to find, and they can be also cyclical, because a trade or an asset can deliver alpha in a certain cycle, and it can also be alpha negative in another cycle. So whilst the risk on and risk off, let's say they are more stable in terms of we know who they are. We can, of course, we also try to find the best defense strategies, the best risk on strategy for the market environment we find ourselves. So if you look at the classical risk on, these a spider chart, the middle is 0, the extreme value is 10. So this is a classical risk on strategy with a lot of big sensitivity to beta factor. It's a mirror of the risk on strategy and risk off strategies, which has a lot of sensitivity to the defensive factors, and an alpha or uncorrelated strategy is a trade or a strategy that has no correlation either with the risk on or risk off type of strategies, buckets, but has a correlation with alpha factors. And we aim to combine with stable return, we aim to combine everything together. So we want to combine beta risk on strategies, risk off strategies, and alpha strategies. And what we want to achieve, essentially, this is just a pro forma. What we want to achieve is a stable return in the long term with preservation of capital during market volatility periods. The team, so just to be clear, everything is the strategy, everything is internal. We have a team, as you may see, of 8, 9, let's say plus me, 9 professional and on the investment side. We have investment professional with long experience in markets, 20, 25 years, and each professional, each person is skilled in a certain area. It can be distressed credit, fixed income, special sits and equities, macro and commodities. And I look into the strategy allocation and risk management, and our target is always 5% target volatility ex ante. So when we build a portfolio, we have an investment committee. When we build a portfolio, we aim at the top strategies we see in each cycle, and we build a portfolio looking at 5% volatility ex ante. And here you can see the biography of the portfolio managers. And looking at the portfolio construction, we have 3 objectives. One is capital preservation, the second is stable income, and the third is also an inflation hedge. Why an inflation hedge? The profile of the fund in terms of risk is pretty similar to an investment grade, between investment grade high yield type of product, so a credit product. And the problem of the credit products, most of them, is they are short inflation. So although we don't expect double-digit inflation like 1970s, 1980s, also 2-3% inflation for the next 10 years with the very low yields we are facing now on the entire curve of the yield curve in developed markets already means that ex ante, most of the investment grade, some high yield products are going to deliver zero or negative real returns. So we want to be long inflation. So we want to be long assets that can give us sensitivity to inflation. So a positive return if inflation goes up, inflation spikes. So we want to be, in this way, we are going to be negative correlated to investment grade, but with the same volatility and risk profile. And the three building blocks, as we discussed earlier. So we have three main building blocks. The red dots, is the risk-on type of strategies, can be between 0 and 50% notional. Then we have the risk-off, which are what we call anti-bubble, anti-crisis, all the tail risk defensive strategies. Again, they can be between 0 and 50%. And then the uncorrelated alpha, we try to be at least 50% in these instruments. Of course, it's always hard to find these opportunities. If you don't find enough opportunities to be 50%, we can also be less and use cash or short-term high yield as an uncorrelated alpha type of instrument. And here is the final composition of the strategy. So just a quick look at the peer group. I think it's interesting. So here we just put other three funds besides Quadriga, Return, QSR in the first row. And so that mostly all performed pretty well since January 2020. Norberg and Berman uncorrelated strategies at a more, let's say, flattish performance at 2%. But we want to compare here with Nordea Stable Return. The aim of what we are showing is not to demonstrate that these other funds are not good. These funds are pretty good. They've been very successful in the past 10 years. And what we want to show essentially is our source of returns are completely different. It's completely different from their source of return. So we can be a very good diversifier in a portfolio where clients combine these type of products together. So in the chart below, we put together, we rank the returns of Nordea Stable Return from the worst to the top. And then for each month, we put the return of stable return in the specific month. And we see that in the worst month for Nordea, Quadriga Stable Return cumulated -2% compared to Nordea, which cumulated almost -11%. So just 20% downside beta to Nordea Stable Return. During more flattish markets on Nordea Stable Return, also Quadriga Stable Return was kind of positive, a bit more positive than Nordea Stable Return, accumulating 2.5 against 1.6 on Nordea Stable Return. If you look at the more bullish market, bullish month, top month for Nordea Stable Return, Nordea accumulated 20%, whilst Quadriga Stable Return accumulated just 7.5. So essentially, we are more balanced in terms of making money during quiet months and decent months, and we preserve capital during down months. So the idea is to obtain more or less the same result as Nordea stable return, but we obtain most of our alpha when markets are in a volatile environment. And going into the December update, we have this amount 30 basis point up compared to minus 1.2% of the European investment grade index. And we ended the year as minus 1%. It's been a disappointing year, also a volatile year for the strategy. The month has been, the year has been very positive for markets, with Standard & Poor's up 26% with dividend and including dividend, and also in terms of volatility going down. So it was more a linear market for equity positioning, and we had, let's say, tough month that that made our strategy suffering in those few months, and then like September, for example, and then at the end we had the last 3 months, October, November, December, pretty positive. In total 1.2% in the last 3 months, but we couldn't record, let's say, the year to date. So at the end we ended up -1, but we're still up 8.5 since we started the strategy. The point in this is we started the strategy as at the beginning for regulatory issues. We started the strategy as a fund of fund, and then we moved into a single manager fund where the team I showed earlier is managing directly the strategy, choosing the trades, choosing the instrument. So we now invest just in stocks, bonds, and derivatives, long and short. And this new setup has just started in October last year, sorry, end of September 2021. And so since we started, we had accumulated a decent return with a very low volatility. So we are still, since we started, we're still in the process of slowly adding trades, especially the last 3 months. We added very small trades because it was end of year, and we converted the portfolio from a fund of funds into a single manager portfolio. We started as a fund of fund because essentially was as the fund was in place, the prospectus was essentially a fund of fund prospectus we utilized to start this project, and for regulatory purposes and some issues we had with the regulator, it took kind of, especially for their delays, it took almost a year to change the prospectus, but finally, eventually we could change the portfolio by the end of 2021, and so now the strategy is, let's say, the framework is the same: risk off, risk on, and uncorrelated strategy, but now we are more flexible. We are also quicker in terms of taking profit and stop losses, and we are in 100% control of each trade in the fund. And so here it's a year-to-date comparison, 2021 comparison between European investment grade and stable return, and we've been kind of more or less similar volatility of European investment grade. At the end, different return, slightly better for Quadriga stable return, although both of them ended the year negative. And these are the final contribution on NAV for each bucket. So the risk on contributed very positive, the risk off very negative, and uncorrelated slightly negative for the year. And here is the portfolio. The portfolio today. This portfolio is still very low leverage. We are essentially adding position. We didn't add any position by the end of the year because of low liquidity environment, and was still, let's say, we wanted to wait beginning of 2022 to add positioning, and we are adding positioning now. And so you're going to see some changes next month. So by the way, we have 11% in risk off strategies, which is a relative value defensive trade. We are long stocks that are more in the food and beverage, high quality in Europe, and we are short beta neutral the market. On the risk on side, we are trading option, call spread and call on European stocks, European index, and also European banks. We have some exposure in dollar against euro as FX uncorrelated opportunistic type of exposure. And so concluding the update, I want to talk just quickly about the macro for 2022. There are three main themes or narratives for this year. One is inflation, and economists they expect in US CPI end of 2022 for 4.2%. But remember one thing, in January 2021, economists expected a CPI for 2021 of 1.8, and we ended the year with 6.8. So this is one issue. The second issue is China. There's been, let's say, deceleration coming from real estate deleveraging, and I think a sustainable policy of zero COVID cases can be a trigger for this year, or maybe slower China growth. And this, I think this element is the one that really market is not considering much, and can be very, let's say, it can be bad for emerging market, but also can be a deflationary globally, and generally can be bad also for developed market stocks, especially for the one like Europe, who depends a lot from China imports. And then of course there is a US growth. Economists decrease expectation for 2022 starting in September, and then with the Omicron variant coming into by the end of the year. So from 4.3 GDP real growth, now they are aiming at 3.9, but still, as you see, economists adjust the expectation along the way. So I think there are potential issues there too, where the market maybe is not considering. So what we are doing here, trying to see what can go wrong in 2022. What are the global concerns? Not to be just long equity and nothing and doing nothing, let's say. Regarding inflation, it's something that maybe is not going to be the thought as the market narrative is saying. If we see the breakdown on inflation components in the past 5 years, we see that the last year there is one component which services, they've been pretty stable, and also food has been kind of stable in the past few years, increasing a bit during COVID and keeping also higher prices also last year, but they're not been the game changer. The real game changer last year have been energy and goods. In terms of energy, oil and natural gas have been up between 65 and 70% in 2021. They started 21 with prices for oil around 40. So now the prices of oil, we are starting the year with higher prices. So there is a kind of a base effect. So unless oil prices are going to get to 110, we are not going to see huge increase again of energy prices this year to like last year. This for energy. The second big change, as you see, is the red bar, the goods. If you look at the past 5 years, goods have been essentially deflationary. And when we're talking about goods, it's ex-food and energy. It's mostly also technology and retail, apparel, so clothing, and they've been deflationary because of technology, because of huge supply in the market, and also huge supply from emerging countries that supply this type of goods at lower price for lower cost of labor. So if you just look not very long term, but just 5 years, you see the red bar has been between 0 and negative. But starting from mid-2020 and especially end 2020 and all 2021, getting very extreme during 21 and 2021, goods has been a very big contributor of inflation. And this inflation, so is coming from, first of all, supply issues. So we know that been many tankers been, let's say, blocked out of the ports in California, in China. So there's been a demand, or there's been a very strong demand and a supply that couldn't meet this big demand. So this supply shock increase a lot the prices, also for materials and other things, for construction, for example. So the construction has been pretty strong in US real estate, and also in Europe with different fiscal impulses from the European Union, also from each country like Italy, Spain. So the construction demand has been very strong, and material barely arrive every month. So what happened essentially is there's been a shortage of material and in each country, and the prices went up massively. And so that's what happened. So if we see, so go into inflation, if we see a drop in this supply delivery, and that's why we always watch the ISM supply delivery indicator. If we get again around 55 and we see that supply shock is a bit during this year, we can have the goods component come down. Still, there's going to be some inflation there, more, of course, than 2017, which was deflationary for the year, but I think it's going to be less than 2021. And other thing to watch is, of course, inflation expectation. Although the inflation reached 1980 levels, inflation expectation is still lower than, for example, 2013. We see the white line for US and the blue line for Europe in the first chart. So market is still expect not very high hot inflation in 2022 for the next let's say 5 years. So we are using inflation expectation 5-5, inflation swap forward 5-5 to assess market expectation, and we always watch this indicator because market expectations are very important also for realized inflation. So on this inflation, we are not in the camp of very big inflation, like others say. I think there's going to be inflation, yes, more than 2020, 2019, or more than 5-year previous pandemic average. But maybe, but inflation is going to be, of course, lower than 2021. And in terms of slowdown in China, there is one indicator we always look, and there are different variety indicators, but we watch at the credit impulse. We saw a small reversal in the November month, but still there are, so maybe what, and then there have been few changes in the reserve policy. So the banks, they are allowed to have less reserve. The Chinese banks, they can allow to have less reserve, but still we see there are few things that scare us in terms of potential bad news coming from China. First of all, this COVID zero policy. Essentially, either they've been hiding their numbers since the beginning of the pandemic, or sooner or later they're going to have like a huge spike anyway in COVID cases. And if it depends on what they're going to be their reaction. If they're going to shut down, like a brutal lockdown, can be bad for the economy, although it's going to be for the short term. It's going to be bad for a quarter or a couple of quarters. The second is the economy has been in deleveraging mode for the past year, and the banks, although they are allowed now to increase their credit to non-financial corporation, we need to see if they're going to do it. You will see if there are companies that want to get this fresh debt. And this applies also for real estate sector, which has been a key growth sector for the Chinese economy, and they are just outside. They're just out of the big deleveraging process, where few players have gone into bankrupt. So I don't know if real estate is going to be like an important sector. It's going to be a growth sector for this year and next year in China. So this also can affect the Chinese GDP growth. And in terms of US growth, we see here the expected growth by economists. And let's say we have few issues. There is, first of all, potential mistakes from the Fed that can tighten more than markets expect. And this can be a year where stocks multiple can contract. So we have been seeing stocks that with a multiple of 40, 35, well, what they were said to be quality or good value, because with rates at 0, you can have essentially a P of 50 and you can be a good company, a good value company. Whilst because the multiple with the 0 interest rate, the multiple went into the sky, especially with top line growth in the revenues. Whilst now with, let's say, higher Fed funds, higher yields all along the curve in US, I think this year we're going to see some multiple contraction. So watch out for stock that trades a very high multiple with potential unsustainable growth of the top line. And of course, they're always around the new COVID variant. They can surprise us, and or maybe higher than expected inflation, or still the current inflation that can, let's say, slow the consumer spending US. And also US growth expectations are pretty linked to what the Biden administration can do. And that's why some economists, some banks, some sell-side analysts like Goldman Sachs, they lowered GDP growth expectation due to political impasse now, where in the Senate they cannot approve the new fiscal spending. So there are few elements that can deliver kind of volatility this year around the US growth expectation and the US stocks. So that's it, and thanks for your time. As usual, these are the free share classes available, but we just launched also share classes in other currencies, also in dollar and pound. Same type of fees, like the B and the C, so 75 basis point, a flat fee for institutional retail and a minimum, and 1.75% with rebate for distributors. And the fund AUM is still at 44 million, daily liquidity, daily pricing, and we are registered in Spain, Italy, Luxembourg currently, and we are looking into opening new countries like Germany and France as soon as possible. So with this, I thank you for your time, and looking forward to update you next month. Bye.